Good morning, happy Thursday today. We are excited to go in Plano. We have a 1 hour networking event. This is I've been doing this for the past 2 weeks. That is how we secure. We just have to start early, stay late, work smarter every day, and no matter what it takes, we're gonna hustle and bustle our way up to the top. Last Tuesday, we covered about how to secure your business, the future of your business. There are two key points that we discussed. The number one, well, I'm trying to just shorten it because I only have 30 minutes for the takeaways on our presentation last time. We discussed about always review. Number one is always review your finances. That's the best. They're forecasting quarterly meeting, whether with your accountant, with your tax professional, or whoever is handling with your numbers. Then number two, it's try to diversify or invest with some uh, aside from the income of your company, you need to diversify. Diversification on your business.
In a quarter mile,
Oh,
turn
God.
right.
She's how is she though? The investment or diversification is be just building a solid foundation that you have multiple income stream within the given business. We're gonna go over with that, but also at the same time, it helps you to build an asset accumulation. We're gonna go over how does asset accumulation works when choosing an investment. What an investment right for you. All right, so let's talk about the forecasting and basically your profit and loss statement, balance sheet, tax returns. These are basically or the blueprint of your company where how it performs. Are you making money? Is this business has potential to expand? Would it give you the lifestyle that you need? Ideally, when you are starting a business, every quarter would be the time that you need to check your profit and loss statement. The profit and loss, it's like the human body. It explains the different system, the different parts of the body. Like you have the brain, you have the digestive system, you have the skeletal system. On the profit and loss statement, there are different things that you're looking at. How much is your income? And then how much are your total expenses? When you subtract those two, that is the net profit. So the net profit is the remaining amount of money when you less your expenses on top of your income. And that is will determine whether you have good cash flow. Ideally, for me, what I always tell to the client, the first 2 years in the business, it could always be losses because I mean you're all putting as a startup business, you're not making any money yet. It's just basically you're building the foundation from either if you have a retail store, your a lot of your expenses are with the improvement, the design, the interior and exterior structure of your building. That's why whenever you see your profit and loss on the first quarter, you have so many expenses at the beginning, so and even zero profit the first 1 or 2 years, and then you should experience on the third, fourth year of your company, you have to experience a break-even point because that is where the break-even point is. You're making money, you're also but your expenses is equal to your income, which means you're no longer losing, but it's a break even, which means maybe some of your uh, marketing is working. That's why it's giving you stay in the break even point. The third or fourth year, you have 15% take home money or the net profit from your company. Because that 15%, at least you have something. This is the time that you haven't put yourself yet on payroll. Because I mean, if you need to be paid with your company. Your company is not a charity. You're not doing it for free. So now, for me, after fourth year, you should experience tremendous growth, either 33%, which means the net profit should be 33. So that's the reason why you're checking your profit and loss quarterly to kind of review what are the different income and the different expenses. So the different income, let's say in a coffee shop as an example, you're gonna check which one of the following income that we produce pero we spend less. Let's say you have you're selling coffee, but also you're selling shirts, hats. You also do catering for your company, for your coffee shop. You've been hired for private events. Then as you go along the way, you've noticed that there's so much inventory in your coffee. There's so much expenses and marketing in your coffee, but you've noticed that catering it's actually making more money pero less work because you don't have to open you don't have to extend the hours. All you have to do is to maybe to book on the weekend, but they're hiring you between 5 to 10,000 contract regularly. So from there, you're going to assess if we're going to focus on you have to focus on what is making money but spending less effort or less expenses, and then you want to maximize that potential. Rather do massive catering, especially in the slow season, and then at the same time you minimize the manpower on your coffee shop. Maybe 3 or 5 people sometimes because aside from the cost of goods sold, the major expenses also are manpower. So you're gonna find ways how to minimize those that eating the chunk of your income, right? But at the same time, in the marketing aspect, let's say you're pushing your marketing and you're spending budget through through your digital marketing, and then you're spending budget in the newspaper. You're being part of the chamber of commerce. Any type of organization promotes the business. You also have to identify which of these really are giving us referrals. If you're spending 23,000 of dollars on digital marketing, but your customers are local, that they just grow because word of mouth from one establishment to another, so you kind of have to reallocate the budget and intensify the marketing, local marketing budget. You could do PR campaign, TV interviews, because maybe your market it's the really not the one, the young generation, maybe they're the one that are the baby boomers to go and they want to go to your coffee shop every morning, right? But so that's how you look on it with your finances. So that's why it gives you that kind of informed decision. The thing with the business, when you already have that passion and you love what you're doing, uh, the business is very objective. Either you, you just have to have the tough uh, there are so many tough decisions that you have to make, whether you let go of the person that's not productive, or whether you let go of the product that's not selling but costing you too much, or sometimes you cut the hours of your operations and you open it a little late or a little early. So which one of this? So you're gonna look on that. That's why it's very important to look on this, because they said action. I forgot. What did they say? Action without vision, or vision without action is daydreaming, but action without vision is a nightmare. So that's what I've learned. I don't know who's the author, but what that's one thing that I've been remembering. Numbers don't lie. Then eventually, you also want to see that your company, as like what I've said a while ago, it's not a charity. You have to put yourself in the payroll to cover your personal. So that is where you can reclassify your personal expenses becoming business expense. And now, on the others, planning on the future of your business, it's when you already have so good cash flow, 33% or 55%, you're only spending 50% of expenses, and then the rest is a take home. Remember that 55% of whatever income is taxable. So this is the time that you want to do a good to diversify your money. Let's in a given Okay. So yeah, like what I've said, eventually you have so many taxable. Let's say you made 2.3 million, and out of that you still have a 300,000. 2 million is the expense, and you still have 300,000. What are you gonna do with the 300,000? Do you want to pay Uncle Sam? That's subject to what? That's a lot of money to pay the IRS, maybe $90,000. So what you're gonna do is might as well just purchase the coffee shop to the owner, so you could have that building, and then it becomes the asset of your company. It's a real estate investment, and then you will benefit from the depreciation of that building. Then you don't have to do the mortgage no more, but rather you would just have to convert and rent to your own company, like have another LLC that owns your own LLC that will own the building, and then your coffee shop will rent your real estate business. So that's one way of doing it. So that's diversification. Now, the other part of diversification, like you have to put yourself on payroll, especially if you're an S corporation, and from there you can open investment or any bonus defined benefit plans to you from your travel reimbursement, healthcare, insurance. You could be an asset of your own company. So therefore, instead of you paying the $300,000 to be taxed on the 300,000, which is somewhere like 90,000, instead of you, because it's 30%, instead of you paying that tax, you put it back to yourself. It's where you park your money. Remember, the IRS allows you to put your money, taxable income, to any tax sheltered account. Like you can open your own annuity, your 401k, defined benefit plans, reimbursement plan, and then issue yourself a salary. So those are the things that you can do. Now, from 300,000, let's say you issue yourself a 200,000, you're only be on the salary in a year, because that's the ideal salary for a manager based on your experience. Then the remaining taxable income for your company is only 100,000, and then you could invest again that money, whether you want to put up, if you have kids, you could hire your kids to be employee of your company. So that's another expense of the company. But your kids, instead of asking for allowance, you could have them to work for the company. So that also help them sense of to develop sense of responsibility. uh, Health insurance also, you could build asset accumulation. So maybe you could offer open your own in life insurance that has a cash accumulation, and it could be an index universal life, it could be term insurance, it could be just the whole life. So there are so many ways of there's so many room to grow when you have your own company. But then I know this is complex, so we're gonna have a replay. I'm already here in the venue. Remember, the tips of growing your business would, it's more having, checking and having your financial statements always ready, and even your tax returns always ready. It's a course of habit. If you've been doing it every quarter, your body and your mind will always gonna look on it. Okay, so that's why we're gonna do. So if you are listening, just click share and subscribe on our channel. Okay. Oh wow. Did I just come here last time? So what's the venue? Pit Grill of Plano. Ah, okay. Okay, this is only an hour, so I have to make the most out of it. Maybe I can start working here. All right, because just we break your taxes so you can